Most people assumed the United States was built with strong banks. It wasn't. Early America deeply distrusted financial institutions. After independence, centralized finance felt dangerous. It reminded Americans of British control, elite power, and wealth extraction. There was no permanent national bank, no central authority. Each state operated differently, and local banks issued their own money. This chaos was intentional. It reflected America's political DNA: decentralization, local control, and deep suspicion of financial authority. But an economy without coordinated banking cannot scale. Trade, infrastructure, and industry require trust, credit, and stable money. America was growing fast, but remained financially unstable. This tension between freedom and control would shape every banking decision ahead. As the economy expanded, America's weak banking structure became dangerous, unable to support growing trade, industry, and national economic complexity. Financial panics erupted repeatedly. Banks collapsed, credit vanished overnight, and ordinary people lost savings with no protection or warning. The Panic of 1907 nearly froze the entire system. There was no central authority, no lender of last resort. With no emergency control, private bankers stepped in to stop collapse, revealing how fragile national stability truly was. This moment terrified policymakers. Growth had outpaced governance. An economy this large could no longer survive on improvisation alone. Stability required coordination, but Americans feared central power, forcing solutions to appear decentralized, even when real control increased. In 1913, the United States created the Federal Reserve, but it was never introduced as a powerful central bank. Instead, it was presented as a system of regional banks, shared authority, and deliberate distance from political power. This design was intentional. Americans feared concentrated power, so the structure appeared decentralized while real control remained centralized. Behind the scenes, the system unified currency issuance, managed liquidity, and stabilized credit across the entire economy. For the first time, America had a permanent financial coordinator, allowing crises to be contained instead of destroying everything. The Federal Reserve didn't replace capitalism. It stabilized it, permanently tying economic growth to central monetary management. Banks and government institutions gradually grow interconnected, forming a financial loop where lending supports national expansion while policy frameworks quietly shape economic direction. As industry expands, businesses demand more credit, pushing banks to increase lending while infrastructure projects and factories multiply across the national economy. During wars and economic downturns, central banking authorities intervene to stabilize credit, ensuring banks remain operational despite financial shocks threatening production and employment. This intervention blurs boundaries between free markets and managed outcomes, as financial stability increasingly relies on policy decisions rather than pure market discipline. Large financial institutions become too important to fail, concentrating influence while governments prioritize stability to protect savings, employment, and national economic confidence. By mid-century, American finance grows globally dominant, powerful, and resilient, yet increasingly dependent on coordinated policies managing risks beneath apparent stability. Unlike state-controlled banking systems, American financial power operates quietly, structured to guide behavior without visible commands, relying on systems rather than public authority. Interest rates and liquidity decisions subtly influence borrowing, investment, and survival, shaping economic outcomes without direct orders or dramatic public announcements. Rather than commanding the economy, the Federal Reserve nudges it, quietly affecting employment, inflation, and asset prices through indirect financial adjustments. Because these mechanisms feel market-driven, banking authority remains largely unquestioned, operating structurally through incentives rather than visible enforcement or direct intervention. This quiet structure strengthens trust in the dollar, reinforcing global confidence while making American finance resilient to shocks and external economic pressures. People experience inflation, booms, and recessions without seeing decision-makers, creating a gap between daily impact and hidden financial control shaping outcomes. Each major financial crisis exposed the hidden structure of American banking, revealing how control quietly emerges only when economic stability is threatened. The Great Depression shattered trust, forcing government and financial institutions into unprecedented intervention to prevent complete economic and social collapse. During the 2008 crisis, banks, markets, and government revealed their deep interdependence as emergency actions replaced normal market discipline. The Federal Reserve expanded its balance sheet, rescued failing institutions, and stabilized markets, acting decisively to preserve systemic survival. These crises proved markets alone cannot endure collapse, establishing the lender of last resort as essential to modern capitalist systems. Crises clarified financial power. Risk remained private during booms, but losses became collective during collapse, redefining free markets in practice. The American banking system runs on credit expansion, treating debt not as failure, but as fuel powering households, businesses, and government growth. Banks sit at the center, transforming savings into loans, channeling borrowed money across the economy to accelerate production, consumption, and investment. Credit allows growth to move faster than savings alone, but it binds economic stability to confidence, interest rates, and continued trust. When credit flows freely, consumption rises, investment expands, and asset prices climb, lifting employment and optimism across the entire economy. When credit tightens, pressure spreads quickly through mortgages, markets, and jobs, revealing how deeply leverage shapes everyday economic life. America accepted leverage as risks, building institutions to manage cycles, creating an economy that grows through debt. Powerful, flexible, yet always fragile. U.S. banking power extends beyond borders because global trade runs through dollars, placing American institutions at the center of worldwide finance and settlement networks everywhere. International banks clear transactions through U.S. systems, governments hold dollar reserves, and corporations borrow globally in dollars to manage trade, investment, and risk worldwide markets. This structure grants extraordinary leverage, allowing access to dollar systems to be granted or denied, shaping behavior without visible force across governments, banks, and corporations. Sanctions succeed because payments depend on dollars, while Federal Reserve swap lines stabilize foreign economies during global financial crises by supplying liquidity when markets freeze. No other country provides comparable financial infrastructure, making the U.S. banking system a core pillar of global economic stability trusted during uncertainty and cross-border stress. In uncertain moments, capital flows toward U.S. markets, proving this power is operational, running through balance sheets, payments, and trust rather than symbols or speeches. The system grows stronger but stressed. Asset inflation favors capital owners. Households lag behind, creating inequality. Wages rise slowly while financial markets recover quickly after interventions. Political tension rises as ordinary citizens feel inflation and debt while the invisible system stabilizes markets. Trust erodes slowly, challenging the perceived fairness of financial management. Public debt increases with repeated interventions. Citizens notice rising costs while markets bounce back. Questions emerge about long-term sustainability and whether confidence can persist without consequences. Stability exists, yet strain grows. The banking system functions efficiently, but social legitimacy declines. Managing growth, inequality, and credibility simultaneously becomes increasingly complex and politically sensitive. Systemic tension defines the next phase of American finance. Powerful banks continue operating, but the public watches closely. The invisible structure must navigate growth pressures and social scrutiny. The U.S. banking system quietly runs the economy. Decisions occur behind the scenes, determining growth, risk absorption, and crisis resolution, shaping everyone's daily financial life without notice. Invisible power governs mortgages, markets, and inflation. Citizens feel outcomes, but rarely see mechanisms. Banking decisions ripple through society, touching savings, employment, and consumption in subtle, continuous ways. This unseen system explains rapid recovery from shocks and persistent deficits. Capital flows efficiently, banks stabilize markets, and global influence extends quietly through structured financial infrastructure. Yet invisibility carries costs, inequality, instability, and recurring crises. Ordinary people often bear consequences while institutions operate safely, preserving confidence and market stability above daily perception. Understanding America's economy requires seeing banks as structural forces, not villains or heroes. Their decisions quietly shape outcomes, influence policy, and determine who benefits from economic growth. The story isn't over. Debt rises, technology evolves, and global competition intensifies. The question is whether this invisible system can maintain control in a changing world.